Hope you are all safe and well once again. We have another great session in store for you today. But before we begin, I'd like to first say once again that our thoughts and prayers are with everyone at this challenging time. We'd also like to extend our heartfelt appreciation to the many first responders and healthcare professionals that are clearly going above and beyond and working so hard to keep everyone safe. Our thanks to all of you. By way of introduction, I'm Rodney Sullivan. I am the Executive Director of the Richard A. Mayo Center for Asset Management here at the University of Virginia Darden School of Business. It is my pleasure to welcome you all here for today's call. The Mayo Center is a center of excellence at Darden with a focus on applied academic research and education. And consistent with that mission, the purpose of this virtual seminar is to advance the study and practice of asset management, of course, through research and education. I'd also like to take a moment to thank our co-sponsor for this series, the Financial Management Association International. Let me share a few housekeeping items with you for today's call. All participant microphones have been muted and videos are turned off. For those of you having questions for today's speaker, please send them via the Q&A box located at the bottom of your screen. We will collect the questions throughout today's session and we'll put as many of them as we can to our speaker following his prepared remarks. Note that you can download Andrew's slide deck from the Events tab that's located on the Mayo Center for Asset Management website. In the coming days, we'll also post a recording of today's session on this same site. So with that, let's move on to today's program. It is my pleasure to introduce our moderator for today's program, Professor Mark Lipson. Mark is the Robert F. Vandal Professor of Business Administration here at the Darden School of Business. Mark, over to you. Thank you.
Thank you, Rodney. It is just wonderful to have you all joining us once again. Welcome to those of you who are new to this webinar. It's great to see so many familiar names and faces, I suppose. We are really fortunate to have with us today Andrew Caroli, who is the Harold Bierman Distinguished Professor of Management and Dean of Academic Affairs at the Johnson School at Cornell. You all, I am sure, are aware of Andrew as a leading scholar in a number of areas, but really most certainly in financial globalization. Many of us know his work well, and I've got to emphasize that keeping up with Andrew's work and its impact on our thinking is an ongoing task. He is no less productive now than he was at any time in his career. And even if you do not know his research, you are likely to know Andrew through his contributions to the profession. He is well known as the former executive editor for the Review of Financial Studies and as president of the Financial Management Association. For me, Andrew has always been simply a friend to scholars everywhere, someone who has had a particular passion for young scholars, and someone who thinks constantly about what are deep and important global issues and how we can get scholarship to focus on those and really bring to light things that we really need to think about. So I can think of no one who is better suited to reflect right now on how these recent events we've seen with COVID are going to affect financial globalization. So with that, let me turn it over to you, Andrew, and with my thanks to you for taking some time to join us.
Mark, those were incredibly generous words. Thank you, my friend. I really appreciate it. I appreciate everything you, the Darden crew, Rodney, the Mayo Center are doing. This is a wonderful community gathering of scholars and others who are really interested in asking interesting questions at a difficult time. And speaking of difficult times, of course, my thoughts and prayers also go out to all those many who are affected by the COVID crisis. It seems that we all have people we know in our near us now that are affected by this. And these days, I often think a lot about my young colleagues, many of whom are living alone, PhD students of ours, who are sort of trying to advance themselves, already under great pressures, but now even more so. And I hope this brings a little bit of brightness to their day, just to think about some issues, pushing research forward, you know. I guess the third thank you is to Cam Harvey, who did a wonderful job setting the table 2 weeks ago. Great choice by you guys to to launch the series with them. He painted a real fascinating picture of where the times we live in and how it matters to capital markets around the world in particular. So I'm taking my inspiration from him to talk a little bit about, and that's the title of this talk, reflecting back on research that I've done in the past and also in the more recent past. I'm going to share some current work with you as well during this little half-hour talk to sort of inspire a nice Q&A. I'm thinking again about young scholars and maybe, just maybe, some of the things that are happening in the markets today, and how one who has been around a while is reflecting on some of the research they've done in the past might inspire them in some ways for their own research program. So let me get started here, and I'm going to show you. I'm going to share my screen. That's what I'm going to start with, if I may, and hope everybody can hear me well. Mark, can they see it all right? I think they can. Thank you. So, ladies and gentlemen, Cam showed a picture not too dissimilar to this 2 weeks ago. This is the S&P 500 since January. You can see what has happened here. I'm going to borrow shamelessly from a wonderful timeline that Adam Tooze, the author of Crashed, supplied to the London Review of Books last weekend. And just to show you some sort of key points of time during this last several weeks here, you can see that the beginning of the decline in the S&P 500 can be timed right around February 14th. That was a day around which the IMF highlighted that this risk might actually be spreading to a number of countries beyond that didn't possibly have the capacity to manage it under reasonable conditions. And it was really about February 22nd, 23rd that there was another big drop in the US markets, at least, which revealed Beijing's successful containment, but yet Italy and Milan is where a lot of this sparked. And this is when there was an escalation of discussions about the loss of output potentially around the world. You can see the US took a breather for a while, and then there was that critical weekend, that March 7th and 8th weekend, where things really dropped dramatically, big downdraft in anticipation of reductions in demand from China as a result of this crisis, and the breakdown of discussion between Russia and Saudi Arabia, and cuts in production, and in terms of the oil prices taking a dive. This is when the markets really declined. Now I'm going to overlay this, just for interest here, with what was happening to the MSCI China index, and you can see the movement downward was a little bit earlier than the case with the U.S. This is when the Chinese leadership announced that perhaps they were going to take this unprecedented lockdown in Wuhan at the center of it all, and you can see the markets took a swing downward. So, you know, but look to the right with your eyes, and you see that with the downdraft in the U.S., it carried the MSCI China index down. Now, I'm incredibly sloppy with correlative versus causal statements here, but just let your eyes glide over these things. And of course, it's very natural to think about different markets around the world, and you can see this sort of giant cascading event of these dozen-plus markets right around that time. This is that March 7th and 8th weekend that I'm talking about. Now you sit there and you pause and you go, well, have I seen something like this before? And the answer, of course, is that we have. This is a picture from October of 2018, where we saw this sort of cascading event across markets. It's not necessarily how we always think about this, but at the time, it was clearly this cascading of markets around this October decline during the midst of the global financial crisis. And it was, I love this quote from Nouriel Roubini and his co-author. He was referring to this particular event 10 years ago as history confirming that crises are much like pandemics. They begin with the outbreak of a disease that then spreads, radiating outwards, noting the breadth of the cascade, right? Now you sit there and you say, well, that is a brilliant insight, that metaphor, except that it was something that we actually had talked about sometime before that, probably another 10 years earlier than that, right around what we used to call the Asian financial crisis, the Asia-Russia crisis. This is the decline of LTCM as well, around about the same time. And it was Paul Krugman that was talking about the Russian virus and the Asian flu as if it were a bacteria that caused deadly plagues, but had long been considered conquered by modern medicine and reemerged in a form resistant to all standard antibiotics. So again, this metaphor plays out here, and this was quite common around about that same time. Now, why do I mention all of this? Well, it was because around that time, I took this metaphor. I and my co-authors, Ki-Hong Bae and Renee Stoltz, took this metaphor to heart. Around that time, we had a number of scholars had taken up the challenge to try to understand what was happening during the Asian financial crisis, and tried to think about using sort of standard asset pricing traditional approaches to try and understand the unusual nature of this kind of cascading event. And what we did was we tried to sort of break out of the box here, thinking outside the box, and taking the inspiration from the metaphor. I actually remember reaching out to epidemiologists, trying to think about how they think about modeling empirically things like epidemics and pandemics, and thinking about viral propagation. And what we did was we tried to invoke a new approach to modeling international financial contagion. And here are some of the elements of this approach that were a little bit different. What we did not want to do was what we had seen a number of scholars doing at the same time, which was trying to build these models of time-varying correlations in returns to try to address and capture it. Nothing wrong with that, but we wanted to do something different, inspired from epidemiology. And what they were doing was working with these multivariate discrete choice models to try to capture and understand these infection rates and the pace of infection rates. And for us, we liken the infection rates, just like the metaphor indicates, to large market movements, logically downward, but we didn't restrict it to that. And what we wanted to do was try to project those against some fundamental covariates or predeterminants, economic and financial variables that could be predictive of these types of things. We called these, by the way, exceedances, beyond some threshold, large moves beyond some thresholds, and trying to project that onto covariates or predictors. Then, of course, the next thing was to try to capture epidemics by looking at counts of these exceedances within a period of time. We called them co-exceedances, kind of co-crashing or cascading. And we did this within markets, rather across markets, and for example, logically within regions like around Asia, around the same time. But then our eye was ultimately focused on trying to capture pandemics, interregional spillovers, as it were, from a epidemic or a set of coexceedances within a region to going across regions, to the US, to Europe, for example. Our approach was daily returns horizons. It was about a 9-year period. You know, what was really fun for us was thinking about, we had a number of choices to make as econometricians to try to make this thing work. And what we did was we had to think about, you know, what would be a logical definition for a region within which an epidemic of co-crashing or co-exceedances would take place. Our ideas went to Asia, Latin America, and we kind of grouped things like that. And then we thought about pandemics across regions, as I mentioned. We obviously had to use some choices with respect to threshold events. What would be a reasonable threshold event? Think in terms of extreme sort of 5% tail events for a given market, and then counts of those across markets within a window of time. And then also on the upside, we wanted to allow for that as well, to see if there's some sort of asymmetric forces at work for upside waves of extreme events or coexcedences as well as downside. And then, of course, we had to choose windows within within which we would define an epidemic. Was it 3 days within there was a threshold decline of 3 or more markets within a region, 5 or more, 10 or more? What would constitute a pandemic? And predictive of that were these predeterminants, as I mentioned to you. So lots of choices and so on. So now you've seen some pictures that I showed you about the events of the last 2 months. And I've clearly been thinking about how we would have invoked what our learning is today relative to what we were trying to do way back then. I don't know that we would think differently about regions and across regions, but clearly with the pace of globalization that has happened in the last 20-odd years, 22 years since the Asia-Russia financial crisis, I clearly, and the sheer velocity with which market co-movements are taking place, you've got to think that the arbitrary choices that we made for the sizes of the windows to define a kind of coexcedence period would be much more time decompressed. We probably have to be doing some creative things along those lines. Also, and I've forgotten to tell you what the big findings were from that study, which was that these were in fact predictable based on the kinds of covariates that we had chosen, that they were predictable. They were much more dramatic on the downside than the upside. I'm sure that is not surprising to anybody. But more importantly, and more surprising perhaps, was that the interregional pandemic nature of those epidemic waves that we had documented during the Asia and Russia financial crisis they didn't translate as much to the US or to Europe as much as people were leading on to. Now, I'm not sure I would say that that's what's happening right now. I would think that the sheer velocity with which these cascading events are happening now in the time decompressed way, I'm not sure we could conclude that right now. And furthermore, I would say, we could have been much more rigorous, we would have probably considered more real fundamentals as drivers of these potential coexcedence waves today, given how much today and what we're seeing at this large financial shock around COVID. Yes, it starts from a viral attack on us, but the economic shock is what is reflected in the financial shock. So a richer set of real fundamentals, I would imagine, would have been something that we would have considered here. But I look forward to maybe engaging in the Q&A with people in terms of helping to creatively think about this stuff going forward. Now, let me widen the lens on a second study I'd like to talk about for another 10 minutes or so, Mark, which is about a newer project that I've been involved with. But I want to sort of set the table, maybe with some data that wasn't featured as prominently in Cam's presentation, but still important. And we're looking at maybe the last 2 decades or so in terms of financial globalization. Think of it as the pace of which. And what I'm showing you here is something from the McKinsey Global Institute of what I would call the overall financialization of the economy. This is basically the global stock of debt and equity outstanding in trillions of dollars over the course of this last 2 or 3 decades. And if you look at the very bottom, they're actually deflating it by world GDP. So you can kind of see that during the many years, decades leading up to the global financial crisis, there was a very fast pace of growth in terms of financialization overall. And you can clearly see it reached about 355% of world GDP by the peak of the crisis there, 2007, 2008. And you can see that there was an abrupt shift downward, still going up slowly, but clearly a shift downwards in terms of the pace with which it was happening. Now I'm gonna throw another graph for you, and this is different. This is from Lane and Milesi Ferretti from a 2018 IMF Economic Review study. And what this is a subset of those financial assets and liabilities as represented in the previous graph. but specifically with respect to what we call external assets and liabilities. These are things like foreign direct investment claims, stock variables, a foreign direct investment, foreign portfolio investment. There would be other types of financial instruments included in here, as well as foreign currency reserves in central banks as well. But what I want you to see here, and try your hardest to take your eye off of the red bars, which is the financial claims that are can see their origins in financial centers like offshore tax havens. And that's interesting unto itself, is the fact that the blue bars are the ones that have risen quickly and flattened out. And if you look, those are the advanced economies. The green bars are the ones where there was a continued expansion. It's a little bit harder to see because of the sheer dimensions. So let me show you a little bit different way. And that is in terms of flows. Oftentimes we capture and measure the pace of globalization through the actual size of cross-border flows as a fraction of GDP. And so these are in trillions of dollars. And what you can see, again, going back, this is actually going back to the McKinsey Institute, shows that there was almost a halving post-global financial crisis in the size of cross-border capital flows. Now, this is from wherever to wherever, okay? And you can see it dropped from about 20% of world GDP to about 6 or 7%, and it's continued to today. But remember, I gave you a tip here in the previous slide about emerging versus developed economies. Now look at this picture. This is from the Institute for International Finance. Lots of colors on here, but what this is showing you is that the flows, and these are FDI as well as portfolio flows, emanating from wherever, but targeting emerging markets. You can see that magnified, the pace continued in emerging markets post-global financial crisis. So that downdraft in cross-border capital flows post-global financial crisis was concentrated among the developed markets. Yeah, it's interesting to deconstruct these flows post-financial crisis in terms of, you know, maybe Latin America took a little bit of a back seat. Asia and China continued apace. And even Central, Middle East and Africa, as well as Central Europe, continued during this period. And you can see the actual forms of which in the right-hand side. But the message here is that it's emerging markets that continue to pace post-global financial crisis, and the receding of cross-border capital flows were really with respect to developed markets. Now this led to, we were watching these trends post-global financial crisis, and this sparked research interests among another team with Craig Deutsch, University of Toronto, with Renee Stoltz and myself. And I'm pleased to say this has just been posted 4 days ago in anticipation of this presentation. So I'm quite excited to talk about this. The question we ask is whether or not this pace of flows and stocks in terms of globalization has translated into corporate valuations. So I got to take one step back here. About 10 years ago, there was a whole host of scholars advancing interesting research documenting that when you're studying corporate valuations around the world, that there were really interesting, let's call them wedges or valuation gaps among stocks around the world, particularly with respect to the US. People had documented that there was a significant valuation gap for non-US firms relative to otherwise equivalent US firms. And furthermore, a number of these studies, again, most all of which were in the race up through to the global financial crisis, were documenting that these gaps, these financial gaps or these wedges, were steadily eroding and converging towards zero in the up through with the advancement of cross-border capital flows and de jure reductions and opening up and capital market liberalizations, the reductions and restrictions on these flows, and affirming all of this evidence. With this sort of what appears to be a reversal in terms of financial globalization, and specifically with this interestingly different apparent difference between emerging and developed markets post-global financial crisis, what we did was take it upon ourselves to see if the corporate valuations were reflecting back what we appeared to be seeing here. So let me show you. I'm going to try and advance the slide here. Whoops. There we go. So what we do in this study, real quick, is evaluate individual stocks, Tobin's Q valuation ratios for 20,000 publicly listed companies from 52 countries around the world. Our focus is in the 10 years before and the 10 years after the global financial crisis. Our eyes are fixed on these valuation gaps that previous scholars had documented. And what we want to know is whether these valuation gaps are shifting pre and post global financial crisis, and specifically whether there's a differential evolution in these valuation gaps for developed versus emerging markets. So is this really financial globalization in reverse, and is it so revealed in terms of these corporate valuations? So what we document, and this is sort of the headline result I'm showing you only, is in fact an affirmation of what we thought we might see, which is that there was, in the 10 years post-global financial crisis, a divergence in the valuation gap of non-US firms relative to US firms, approximately 17.9%. So this equation on the bottom shows you this sort of oversaturated panel regression of Tobin's Q ratios on things, stuff, with a focus on that sort of dummy variable for non-US firms. And that's what's revealed in this sort of divergence here. I think the magnitude of this caught our attention for sure. And it, again, affirms people's priors that financial globalization seems to have gone in reverse. But here's the most fun part. When we break this into non-US firms from developed and non-US firms from emerging markets, this differential evolution reveals itself. That is, that this driver of the divergence in corporate valuations is concentrated predominantly, almost exclusively, in the developed market class. About 39.3% wedge in developed relative to emerging markets. So the remaining part of the paper tries to talk about, what is going on? Is this really a manifestation of globalization in terms of those flows that we were documenting for you just a few minutes ago? Or is it some other things that were going on? And here's a host of things that we examine that are not related to financial globalization, but yet that we hypothesize could be linked to this apparent differential evolution in valuation gaps between the developed and emerging markets. Accounting conventions, and specifically the capitalizing of R&D, different accounting approaches around the world might affect our Tobin's Q ratios. We looked at whether there are some really interesting shifts in industrial composition across markets, specifically across countries around the world with respect to tradable goods sectors versus non-tech sector versus non-resource sector versus non. We even look for shifting composition by firm attribute, specifically the rise of intangible assets. Some of our earlier work and others has talked about the rise of intangible assets as an important component of overall assets for firms around the world, younger versus older firms. These are some of the things that we examine and really find no dramatic shifts linked to the differential evolution in these valuation gaps for developed and emerging. But what we do find some positive evidence for this financial globalization hypothesis with respect to this differential evolution is something, again, where we tear a page out of some old playbook that the Deutsch et al. Team has looked at, which is through the form of cross-listings, US cross-listings by firms from around the world. So we think about sub-segmenting developed and emerging non-US firms into the subcategories of those that are secondarily cross-listed in the US relative to those are purely domestically listed at home. previous research has shown that there's a differential valuation between those two types of firms. We call this the cross-listing valuation premium. And that would, of course, be an important mitigating factor for these types of wedges. What we really studied was the patterns, not only in the cross-listing premium, which we demonstrate as being quite resilient through this period of time, remarkably, but what we found towards affirming our overall conclusion is the shift in the numbers of firms that were actually taking advantage of this sort of global integrating mechanism called cross-listing, and that we saw a huge decline in the number of firms from developed markets that had previously been secondarily cross-listed in the US, but now were no longer. Whereas the numbers among emerging markets, forgive the slide there, that should say emerging markets, basically were holding steady. And so we offer this as sort of positive evidence in affirming this sort of financial globalization hypothesis that lies at the root of all that we're seeing. Now, we could have stopped there, and I would have stopped there, except for the fact that a very interesting thing has happened in the last 2 months, which is making us think hard about even this brand new working papers whose results we've posted. And there's this wonderful data that the International Institute for International Finance puts out. This is my last slide, everybody. With respect to, it's called the Daily Capital Flows Tracker. I always check in on this, and I encourage others to. What we have seen, ladies and gentlemen, is an unprecedented unraveling of portfolio positions in emerging markets in the last 2 months, arguably in the last 40 days. 75 days into this quarter, since January 21, we've seen almost $100 billion of egress out of emerging markets from all around the world, primarily in equities, that's the blue, rather than the red. And just to put a framing on this, the right slide shows you just exactly what this massive falling off the COVID cliff capital stop represents relative to previous such events on which there are already so many research papers, like, for example, the global financial crisis, as well as in terms of the taper tantrum in 2013 when the Fed was normalizing capital flows. So I have more questions here I'm offering you than answers, Mark. And I don't know what kind of reaction we're going to get from our colleagues out there, but believe me, I've taken note, my co-authors and I have definitely taken note of this event. I'll stop there. Thank you guys for letting me talk about this work, older work, newer work through this COVID lens. And there are some references for you.
Thank you, Andrew. That's fantastic, and it does provide actually quite a few great lenses to think about what's going on right now. And obviously, what's on everyone's minds is what can we anticipate going forward?
Yeah.
We got a couple great questions that come up. I've sort of clustered these into some categories, if you will, and starting with a sort of broader one, particularly related to the recent working paper. When I think about globalization on the capital market side, I tend to think of two big stories. One big story is we're looking for capital. And so classically, emerging economies might want to gravitate and access capital in more developed economies, and they want to invest abroad. But there's also a great literature, as you know, thinking about capital markets as a way to bonding to higher standards for information acquisition, information revelation or governance. And so we sort of see two stories sitting there. And what intrigued me about your results on the emerging economies continuing to access these capital markets globally, whereas the more developed economies, and therefore the more developed firms, no, I'm fine. And one way we can think of that is, I've got my capital now locally, I don't need the world. Or we can think of it as, I don't need the bonding. So think a little bit and help us think through your recent working paper and what it might say as we think about these two classic economic hypotheses. Again,
Yeah.
an acquisition to capital or sort of a bonding mechanism.
Yeah, no, it's absolutely true. And it sort of reflects my own thinking about this. I think a lot about these, this whole business of sourcing capital internationally, the motivations behind it, very much in the framing of the unraveling of these restrictions that would have otherwise precluded us from doing so, and the upside opportunities from doing so, from bonding to, as you mentioned, to these better institutions that we typically associate with US capital markets. From the perspective of the most recent study, the question clearly in the backdrop there is, why have we seen so many firms, especially from developed markets, decide to unravel their secondary listings? Is it really a statement about the fact that the capital is flowing freely to them anyways through alternative forms? Frankly, within the context of the theories of bonding that we as a co-author team had advocated, that is actually perfectly reasonable. You could imagine that, you could rationalize it in the sense that, we saw an unusually aggressive action post-global financial crisis with respect to the Federal Reserve, as well as other monetary authorities, to ease through the multiple layers of quantitative easing to make money flow more easily around the world. This clearly was a booster charge for things like debt financing as well as private equity funding. And that just represented two very important alternatives for firms to source relative to having to go to take a concerted action to go and reach that money through a listing overseas and a sourcing overseas. That definitely could be part of the story. The one that about the governance makes me more hesitant, because honestly, there hasn't been a sort of a seismic shift in the changes in the quality of institutions around the world in this sort of pre-post global financial crisis era. So I would say, and qualified appropriately, I would say that probably has less to do with what we're seeing here as much as the former has to do with what we're seeing here. That's just my hot take on that. Yeah.
And in that context, many of us think of you as a listings guru, a global listings person as well. And a couple of people wondering, we're aware of in your work on the US listing gap, and we all think about sort of going to public markets or going to private markets. And so sort of two parts of the question here. One thing is, how does this reflect on the changing globalization and where we are going for capital, right? And the second thing is, what might we think about going forward now? Particularly, would anyone want to go listing abroad right now? Do we need the money? Do we not need the money? And as you said, there's a lot of capital floating around with all the quantitative easing.
Well, thanks for mentioning that and connecting it to the 2017 paper that we published on the U.S. listing gap. That was not about cross listings or international listings, but rather domestic listings. And what we had uncovered there was this unusual downdraft in the number of publicly listed companies in the U.S. and how unusual that was relative to much of the rest of the world. And it's not lost on me and my co-authors to be thinking about connecting the sort of the fundamentals, the predeterminants, including the stuff I was just talking about with respect to international cross-listing, to what's happening there. It's no question. And there's been, I should mention that there's been a number of very, very intriguing working papers that have come along since our paper, coming up with rational explanations for why we have seen this unusual downdraft in the number of US publicly listed companies. But you know what? Some of the better ones are in fact talking about the fact that alternative financing sources just simply have risen to the fore to make it less of a requirement for the maturation of a corporation to have to go public, or at least to delay that action much later in its life cycle as a firm. And I don't doubt that the rise of private equity financing, as well as debt financing and all these other alternative sources lie behind all of that. You know, the irony is when we were presenting those papers around and about, that paper around and about, it was people were asking us about how that downdraft is linked to what's happening in international cross listings. And I remember saying to my audience members who would listen, yeah, that we don't really know. And of course, that led to us examining the pace of cross-listing flows in the aftermath of the global financial crisis along the lines of what's featured in here. And now I'm getting questions about domestically listed companies. They're clearly moving hand in hand. The fundamentals that are that are underlying the sort of the movement here in the landscape all around the world is clearly there's a lot of commonalities there.
And one thing that is on a lot of people's mind as we think about this and comparing, as you just did, a financial crisis and what we see going on now, the notion of we can think of contagion, great metaphor in the past, now reality, contagion as stemming from financial linkages. And then systemic risk, which we focused on through financial, or now we're really thinking about an underlying economic links. Do we think about the crises very differently then as we think about prescriptions for solutions or expectations, if it did arise from these sorts of financial linkages, or whether it's linked really on the demand side, if you will, on the economic side?
You know, it's a great question, and it's something I've been thinking about quite a bit as well. I remember distinctly back almost 25 years ago, it was Kristen Forbes and Stein Claessens, and then Rudy Dornbusch, he was still alive, organized this magnificent IMF World Bank joint conference to sort of deconstruct the Asian financial and Russian financial crisis. And it was there where we saw a lot of this work. And I remember distinctly the conversation among those that were sort of pure financial economists, I would liken myself to that, as well as our economists in general that were interested in studying financial markets. And I remember the paradigms. We were asking and pursuing the same questions, but the paradigms that were guiding us to ask and answer those questions were different. And even since, if you go to the MBR IFM meetings, you see, again, different paradigms talking about the linkages in financial and real business cycles that people have been studying in and around the global financial crisis. Similar, but different. And I think one of the reflections that I'm coming to is that my colleagues that are pure financial economists, I think we need to take much more seriously sort of the fundamental real cycles. If this COVID crisis is not the ultimate wake-up call, maybe it should be for us to take really seriously the fundamental real business cycles, maybe even extreme form, as they guide the financial shocks and these financial contagion events, if that's what's happening. I think there could be a much better marriage of those things going forward, and maybe this experience is helping us to go there. That's something some young scholars out there that are looking eagerly for something to follow up on. That might be there might be some secret sauce there that they can follow on.
Yeah, and in that real economic vein, we have in the Q&A and chat here sort of two ideas, one looking back, one looking forward. The looking back one is, how did the trade wars and some of the policies we saw and Brexit and so forth influence the work you did in the changing in the valuation gap? That's the looking back side. And the looking forward side, in a world of somewhat rising nationalism and now rising fear going along with it, what might we see in terms of economic barriers? Can we see sort of a race to the bottom? I'm going to just protect myself.
Yeah.
So both of those, and you could tackle each one, have some interesting implications as we kind of take an overview and think about globalization. What did the trade wars in the recent past manifest? And then what do we anticipate going forward?
That's a great question, Mark. Thank you. I've got, my mind goes in three different directions in thinking about this. First, with respect to our paper, the one way in which we try to tackle this recognizing that there was a significant receding of trade flows that was coincident with what was this apparent decline in capital flows, is where we actually try to separate out the tradable goods, non-tradable goods sector to see if there's any kind of wedge there. The truth of the matter is that differential evolution among emerging and developed markets happens as much as dramatically within the tradable goods sector as it is outside of the tradable goods sector. It doesn't seem to be the explanation for that phenomenon. A second thought that pops into my mind is this incredible, this wonderful editorial by Hank Paulson in the New York Times this morning, where he's asking this very question. You know, this event now follows on several years of receding trade flows that were undoubtedly policy, let's call it trade policy uncertainty driven. And that in turn is leading him to be rethinking as to whether or not this is something that is secular in a decline, or is this something that's temporary that we'll see snap back afterwards. I think we're all asking the questions. I'm not prepared. My dear colleague Cam was making forecasts 2 weeks ago. I'm a little more hesitant about doing that. But you know, it begets the question: is this a transitory receding of trade flows stemming from these policy debates and discussions, the trade wars, as it were? In Paulson's editorial this morning, he talks about the fact that if not now, then when should we be rallying together to support multilateral organizations like the IMF, World Bank, presumably he's thinking about the World Health Organization as well, to sort of bring us to the next stage of life, whatever that is. I kind of agree with a lot of what he wrote.
Yeah, along these same lines then, particularly as we think about there's an underlying economic, well, an underlying epidemic, which has led to an economic problem, underlying economic problem. And we're thinking about linkages between economics, underlying economics, and globalization and capital. So when we start thinking about how we're going to unwind ourselves and solve this, you know, besides the giving money tools we've seen employed, we're going to certainly see a lot of interest rate mechanisms as well. And so now we're going to see perhaps another wave of, or an extension of, driving interest rates downward. So here's an interesting question. To what extent can we think of the attempts to solve the lingering, to the extent there are, economic consequences of COVID to then another financial market implication? Particularly, there's a question we've got about bubbles. Are we going to see now a huge bubble as a result of a policy solution to an epidemic?
Right. And I think that there are certainly a number of fantastic scholars and scholar teams that have attacked an understanding of the evolution of bubbles in the aftermath of the QE program, the low interest rate, sustained low interest rate environment, frothy markets that we saw in the aftermath of the global financial crisis. We're clearly seeing, what did Cam call it, a bazooka. I think he was talking about fiscal policy when he used the term bazooka, but the very aggressive actions by the Fed and ECB for the coming in the most recent months, and whether we're going to see another sustained period. I wonder about that in the context of not bubbles emerging, interesting as that is, but whether that will lead to more intense and more frequent types of financial contagion events, like what we had documented 20 odd years ago, as well as 10 odd years ago. And I don't know how much monetary policy actions are part of stimulating that. That seems like another open research question that has not been fully explored. So it's not, for me, in my mind, it's bubbles, yes, interesting, no question. But for me, it's about the bubbles in international financial markets and the intensity with which they arise and sustain in this new period, this new global pandemic period that we see going forward.
Yeah, I read an interesting article about effects we're seeing on the dollar and a sort of flight to safety. I wonder why they would think the U.S. economy would be more safe in some sense. And again, maybe the dollar in some sense being a global currency. But it did make me think about, of the many things that are moving around in this COVID world, the sense of seeking safety.
Yeah.
And a de-risking of capital in the world. What would you expect as some short-term and possibly longer-term implications of that kind of de-risking?
Well, I'll be honest with you. In my world, studying these flows and these sort of financial contagion types of events, my mind goes to this risk-off environment that I see probably for the foreseeable future as being suggesting that this massive capital stop that we saw in emerging markets, I worry that may not be something that snaps back quickly, that this may be a sustained period of unraveling of positions in markets around the world, emerging markets in particular, in this risk-off scenario. If in fact some of the prognostications of Cam and others that are more optimistic about returning to normal within 6 to 9 months come to the fore, then I could easily see that being not the case, that we see a surge in capital flows back into emerging markets, and that people continue to grab yield as they're prepared to do so. They go into the logical places to find it. Emerging markets is definitely a place where they have historically sought it out. I could easily see a surge following this just as much. That sounds like I'm giving you no forecast because I really am uncomfortable making that forecast. But that paints you the picture of what I think the environment needs to look like for those two scenarios to happen.
Yeah, and I could see emerging markets, unfortunately, sort of having a double hit.
Right.
One is the de-risking, and then their markets drying up as we lock in trade barriers, actually triple hit. And then, of course, they may be particularly ill-equipped to deal with some of the outcomes economically and socially from this.
Well, that's the next thing that's going to drop is if you think about the taper tantrum, that was this extended period of low interest rates that wreaked havoc in many of these emerging markets, because as soon as there was an announced reversal of policy where we were going to start tapering our bond buying expansion program from the Fed and starting to normalize, we saw this rapid capital stop in many of these markets. This is 2013 May. And an immediate receding from those markets. And what we too often don't think about is that there are destabilizing consequences for funding for many of the companies that are based and domiciled in those markets. Their investment programs are sufficiently impeded, and that, of course, has further economic consequences. So I know that I'm sure that there are important monetary and fiscal policy authorities in these markets around the world that are sweating bullets, wondering what will be the fallout from this COVID cliff
Yeah, and certainly to the extent that fiscal policy is being employed as part of this solution, we're going to see massive amounts of debt on the government side, and then possibly massive amounts of borrowing. Already firms are drawing down lines of credit. So there's going to be a whole unraveling of a whole deleveraging phase that might happen after we get ourselves back on track. Let me shift, because we're running out of time. It goes by all too quickly, especially because there's so much great thinking to be done. As a champion of scholars everywhere, and someone who has always paid attention to younger faculty, and that's something that I've always found very commendable about you. What are we going to see in the academic job market now? A question came through with people, limits, global movement, limits on visas, fear in and of itself, and then what many people are viewing as a need to restructure a lot of higher education to reduce costs. So it's sort of like, what are your thoughts about the academic job market?
Well, the first thought is clearly, by the way, thank you for that compliment. I do think a lot about this. I guess I'm swapping my researcher hat on for a deanly hat.
Yeah.
In thinking about answering your question. I definitely think about it. I definitely worry about it. I always want to think optimistically, and I want to think past what is undoubtedly going to be a very intermediate, difficult period, probably for the next year. To the fact that there are going to be some new opportunities that arise. You know, even in the aftermath of the last crisis, the last time we saw significant challenges for our academic job market and finance, we saw opportunities arise with a whole bunch of new universities, places where outside of this country, outside of North America, that made for wonderful places where great research and great teaching experiences could be had. And I know that scholars around the world that might have naturally confined themselves to thinking about the US job market as the one and only place, thought more broadly and more globally about this. I could easily see that happening again, sort of a redoubling of all of that. And you know, I've seen so many universities, I've gotten to visit them, I know you have too, Mark, around the world that are just really equipped themselves to be potential research and teaching powerhouses around the world. And you know, it may be that this is what might come out of all of this.
I think that's
sorry, go ahead.
Yeah, I think that's a wonderfully optimistic and positive viewpoint. Exactly what I would expect from you.
You'd expect that out of me? Okay, thanks.
That's great. We are running out of time, so thank you, Andrew, so much for taking what is precious time to be with us today. Thank you all out there who are listening in on this for contributing and helping us as we try to keep our sort of academic, energetic thinking life done under these difficult times. Before we close, I want to mention that the Mayo Center Virtual Seminar Series, offered again with the help of the Financial Management Association, will continue next Friday on the 24th, the same time slot, 1 to 2 o'clock, but we will be visiting with Maureen O'Hara, a colleague of Andrew's. And Rich Evans, my colleague here, will be the moderator for that one. And finally, I want to thank all the people who make this possible. This would be the Darden team, ASME and IAT. Thank you very much. Get everything going. And Rodney and Aaron and Allie. And of course, Pedro and Rich Evans, my team here. But most of all, let's just, how about a little round of applause for Andrew here. Thank you so much for joining us.
Thank you. It was a pleasure, Mark. Really enjoyed working with you, and thank you to everybody.